we're going to be talking all about restructuring your business for growth. In fact, there's actually more reasons why you might want to restructure than just growth in particular. Yeah, we'll be diving deep into that. Before we get started, there's just a few things that we'll run through. The first one there is I love if people can pop their webcams on. It makes it feel more like a workshop rather than me just staring at a screen and talking to it. So yeah, if you do that, then I would very much appreciate that. And then also the way I present is having the slides on the right-hand side of me as you look at it. So this is probably best viewed in full screen because I will be sharing some sort of detail on the slides. If you want to look at that, it might be handy. And the other one is having the chat box handy. So a few people have already popped in some good day messages in there. So thank you for that. But yeah, I will be monitoring the chat box for questions that might pop up. And the good thing about having a Zoom meeting instead of a Zoom webinar is that we can literally, take yourself off mute and have a conversation to work through something. So there we go. All righty. Well, we're going to get started. And the next thing I want to share is our next webinar, which is in about a week's time from now. We're going to be talking about quite a popular, what would you call it, an issue, opportunity, which is called Division 7A. So if you've got a Division 7A problem, you've probably been told about it or know the word Division 7A. It's not necessarily all bad news, but Div 7A loans need managing and they need a strategy behind them. So if you're interested in finding out more about how to manage them or how we work with them with our clients at Inspire, then feel free to register for that webinar. The link is in the chat box to register that one if you haven't caught the QR code just yet. As a brief introduction to the accounting firm that I run, Inspire. So we're based in the Fortitude Valley in Brisbane, and we work with small business owner clients all around Australia. So yeah, whether you're in Queensland locally with us, or I'm pretty sure there's not a state in Australia that we're missing a client in, and even we've got a few clients in Broome, Western Australia. Interestingly, but yeah, so small business owners is who we work with, and we're well known for saving our clients lots of tax. And the tax planning season, which we're currently in, is the time of the year where we see our tax saving tally go through the roof. So about a month or two ago, that was sitting at about $37 million in tax save for our clients. Now that it's just under 40 mil, and we should see it go above that, which is exciting. Brief introduction to me. So my name's Ben Walker. I started Inspire when I was 23. I'm an award-winning chartered accountant with over 17 years experience, and the author of 2 books, which are actually in the background here. We've got It's All Sorted, that green one there, which talks about business owners and how you handle tax and trusts and structures. And then this one here, which is about business owners and how they it's called Wealth for Life, and how you might create wealth for your family as a business owner. The topic for today about restructuring your business or business structures, I go into that more heavily in this one. It's All Sorted. So if you did want a copy of that, the link is also in the chat box. Thank you, Tay, from our team. And if you are a client and you want a copy of the book, just send us a message, because we have a discount code for clients where you pay cost of the printing for it instead of the RRP. Alrighty. Cool. Well, let's switch gears into what we're going to cover today. And yeah, it's definitely a complex topic. And restructures can, in principle, be quite simple to talk about and to say, but when it gets behind the moving parts in a restructure, it can get quite intense. So yeah, anyway, we're going to go through a few questions why you would need to restructure. And if anyone has, you've registered to this webinar for a reason. If you're a business owner and you've seen the message about restructuring, if you wanted to share, please pop in the chat box what you're considering in terms of what's your motivation for restructuring. Yeah, I'd just love to sort of understand where the audience is sitting at. From that perspective, because there's multiple different reasons you might want to do so. The thing I'll go into next is what do we need to consider with restructures? We'll go into some case studies or common restructures that we see, and then also talk about benefits of restructures. Alrighty. Clara, you've popped in asset protection. That's definitely a big driver for it. Oh, that was a direct message. I don't know whether I meant to share that. Cool, cool. Cool. Well, what we might do is, if anyone wants to share their motivation for considering restructure, pop it in. Otherwise, we will get started. Tax benefit, Sienna. Yes, that's another motivation. Cool. All right. So here's some other um, reasons why we see it. So the one of them, and probably the most common one, is that the client's initial business structure doesn't necessarily allow for the growth or the stage of business that you're at. In fact, Bev, you just commented there in the chat box exactly that thing. So what we start with doesn't necessarily last us for every stage of business. The next dot point there is succession between generations in a family. So that's another one where we've helped, business where the parents might have started it, or even the grandparents, and now we're handing it down to the next or even the third generation to take the reins over. And how we do that has implications from many different angles. There's obviously the obvious one is tax. How the tax impacts both the family who like the parents, if you call it, who are selling the business, and then the children who are taking it over. You've also got estate planning. So how we do that might impact the broader estate planning of the parents who are now selling it to the children, especially when there's other children around who may or may not be involved in the business. And we want to make sure how we do that creates fairness for the family, if that's also something they want to do. But yeah, there's many different considerations. How we look to access small business CGT or capital gains tax concessions with the aging parents. So yeah, many things to consider with succession or intergenerational succession. The next dot point there, increase asset protection of business assets or mitigating business risks. That's another driver. And then another one, which is probably one of the more simple things to solve, is access to R&D tax offsets. And the short version of that one is trusts aren't eligible in their own right for the R&D tax offset, but companies are. So yeah, we need to involve a company in its own right somehow in that structure. So that'll be one of our case studies we'll look at soon. Oh, there's more reasons. Here we go. Exit strategy or plans. So this could be, businesses who may have started, but when or how they're looking to sell might mean that a restructure might make a bit more sense. For instance, you might have a member of your management team keen to buy into the business, or you want to incentivize them through some sort of ownership plan. And we need to make sure that your structure accommodates that, because there may be instances where it doesn't or can't happen. And so we need to do a restructure. Then something like that management buy-in might be able to assist. The next one there is meeting industry requirements. I mean, yeah, hopefully we don't see this too often, but there are certain industries where there's a preference or a mandatory requirement to have a certain structure. And yeah, if you set one up and yeah, I'd hope you haven't set up a structure to then change it straight away. But anyway, it's another thing, adding different product lines. And this is sort of more adds to the asset protection element of restructuring. Product lines is one word, but maybe service lines or different services you might provide to your clients. For instance, there might be multiple things that as accountants we can help a client with. Some have a higher risk profile than others, and particularly advisory work. There are some accountants, we don't, we just keep it in the same entity, but there are some accountants who would have a separate advisory entity that engages clients directly for that to separate the risk from the main or core business. And we see that sometimes with clients where additional services, even to their existing clients, have a different risk profile and they're keen to separate it out, or even licensing requirement is another point. We might see them have a different structure for that. And then similarly, adding locations. So very common, for instance, for franchise owners with multiple franchises to have them sitting in different entities as well, different locations. We see this with medical businesses, physios. They might own multiple clinics location-wise, and they have them sitting in separate entities. And then actually, yeah, so someone's popped in the direct message. Direct message, I won't identify your name, but obviously if you type it in the chat box, everyone can see that anyway. But yeah, someone popped in a message to me saying another reason might be because you're buying a business off someone else. And that's absolutely a great idea. One of our structuring principles is to have different businesses that you run in different entities. So if you run an accounting firm, for instance, you wouldn't put a mortgage, if you ran or bought a mortgage broking firm, you wouldn't ideally put that in the same entity as the thing that runs the accounting firm. And same when you're looking to buy businesses. Even if they're in the same industry or the same thing, there might be reasons why you would have a separate entity anyway, so that if one blows up, it doesn't blow the other one up along with it. That's yeah, that's what we're looking at there. So what do we need to consider? There is a lot. So again, the case studies I'll have on the screen, most of those case studies are across two different slides. I've got a before and after, and there's a couple of dot points of why we want to do it. But in the background, there is so much we need to consider for a client when they're doing their restructure or taking part in that. The first thing, the most obvious one, is current versus proposed structure. There's usually multiple different potential structures a client can have. And it's talking with them and working with them about what's important to them. What are the pros and cons, for instance, between, like, let's look at a broad example, like a company versus a trust. There's differences in how they're taxed. There's differences in how you get the money out of those entities. And so, the process of advising a client for structuring purposes is to understand what's their motivation and long-term goals to be able to give them the best advice at the start or as early as possible in terms of how they structure their business. But even if you've got multiple different end outcomes there, the considerations from the next points we're going to have could all be very different as well. Cool. So that's my next point there, that the tax is a very big consideration. So, sorry, Tay, would you be able to just keep an eye on the waiting room, please? I think there's someone on their way in there. Thank you. But yeah, so from a tax perspective, the two big ones that we need to consider when we're shifting an asset or shifting a business is, what are the stamp duty implications, but also what are the capital gains tax implications? And then can we do anything in either of those buckets to reduce or remove the impact of those taxes? For instance, stamp duty is a state-based tax. There are some states, Victoria and New South Wales where generally on business transfers, you do not pay stamp duty. In Queensland, we're one of the states that you do pay stamp duty, which sucks, but there is exemptions. So there's an exemption, for instance, where you've got a discretionary trust who sells a business to a wholly owned company. As long as you're under a turnover threshold, there's a couple of requirements there, but there are exemptions for that. So that saved clients, for instance, a fair bit of money on the stamp duty and donating money to the state government. All right, and then same with capital gains tax. So generally with capital gains tax, where you sell an asset that's gone up in value, you make a capital gain, even if that is within your own family group, which might sound pretty poor, and I don't like the idea. From my perspective, if it stays within your family and you're shifting it between structures, why should you pay CGT? But my opinion doesn't change the law. So the law says even if you sort of look independently at every single entity, and if one sells to another, you've got to do things like sell it at market value, and that you need a valuation to support that in that instance. But then you also need to consider capital gains tax. And with that, there are many different small business CGT concessions available. And there's eligibility requirements for that. But they're ways that we generally explore to reduce the CGT bill where a client is restructuring and may or will pay capital gains tax. So getting this right is important. The CGT rules are intensely complex in eligibility and also how we apply those to reduce the gain. The timing, the paperwork, it's definitely not straightforward. Now, what are the steps involved? The first thing there is what's your eligibility, and in getting some advice around any CGT concessions or rollovers after you've considered your proposed or potential restructures. And often I guess what I'll share in the case studies is I'm going to be simplifying each of the case studies, but like I'm working on one at the moment where we're actually probably doing a combination of about 3 or 4 of those case studies in one restructure. So again, the benefits or the things that the client's getting out of that are multi-leveled because of the expansion in their business. One very common requirement is evaluation, especially even if you're selling between your own entities. The capital gains tax, there's a market value substitution rule anyway, so we need to know what it is. And often we provide valuations for clients, even in when they're looking for restructures within. And then again, it very much depends on what the restructure looks like, but there's often a requirement to have a commercial lawyer involved to help us with things like share purchase agreements or business sale agreements, vendor finance agreements as well, because often, again, even within a family group, the buyer of the business might not have the cash, so we vendor finance from the selling entity as well, which may also have some fantastic Division 7A benefits associated with it as well. What are the commercial challenges or the headaches, we would call this? I think I'm going to start every sentence with, it depends on the restructure, but it does, of how intense this stuff is. But you've got to consider that in a lot of restructures, your trading entity, the ABN and the tax file number associated with that entity is actually changing. So your trading entity will become something else. But there are restructures, for instance, where there's a trading company and we just move the shares, or how the shares are held changes. That actually doesn't change anything like the bank accounts or the ABN or the TFN of the company. And so for very established businesses, or for businesses where they've got supplier contracts that are very hard to change. For instance, we've moved IT businesses where they've got contracts with like Apple. Apple are a global organization. They'll have crazy terms and conditions, and to get even like an account with them is hard. And even where you've got a client who's selling or changing the same business, they're still the main person in it, but they're changing the entity. That is such a pain for someone like an Apple to go and re-sign and give, similar terms to a fresh entity. They look at it as if it's someone walking off the street applying in most instances. So yeah, that's something to keep in mind. But changing the trading entity and ABN, there will be impact on suppliers, but also your client contracts. So if you go and change a trading entity, your agreements with your clients are most likely with your old trading entity. So there's legal requirements around, how do we solve that? Do we, the lawyers often look to assign the rights of, basically say that, hey, we were the trading entity. This new entity is going to come in and deliver the rest of the contract for you. That's my weird Englishy accounting way to describe assignment. The next one here is moving employees over to the new entity. I mean, it's not that bad, but you've got to, close off the payroll in the old entity, set up the new one, get the lawyer to help with new employment agreements, but also, often we see the lawyers say that, hey, your annual leave carries across, your effective start date for purposes of long service leave carry across, so that the employees don't get annoyed or scared that they're going to lose entitlements that they might have. I don't think we can do that from a fair work perspective, but I don't think we should be doing that to team anyway. It's more so to make sure the paperwork all matches and carries through. And then, there's other things like running multiple Xero files. And mostly this is short term. You might have a bit of overlap where your old entity is winding up and your new one is starting. Again, it's just an administration annoyance and maybe extra cash. And then also the timing. So there's heaps of things that impact the timing. For instance, the time that you sign the contract of sale, if it's a sale or changing the structure, that's the timing of our CGT event. So, is there benefit to signing the capital gains tax? Sorry, is there a benefit to signing the contract on the 1st of July? That means the capital gains tax event is next financial year, but it's also a clean break from financial year to financial year. It means that your old entity winds up at 30 June and then your new one kicks off on 1 July. So it's a clean break there. A month end is better than halfway through a month, and even a quarter. The end of a calendar quarter might be better than doing it at the end of January, at the end of February. But again, there might be commercial reasons that drive an outcome there. Yeah, alrighty. Whew, a lot of content here. So we're going to shift gears into case study number one, and we're going to ease into complexity. So this one's quite simple. So let's imagine the client has a discretionary trust that runs their business. The idea here is the restructure is to allow investment. And so a discretionary trust doesn't allow a fixed interest, for instance, to sell a part or a percent to a non-family business partner or team member. So the instance where you've got a key employee or a manager that you want to have buy a small parcel of the business, you can't do that in a discretionary trust. So what are our options? Well, one of them is, I guess there's two. You can go to a unit trust. So a unit trust allows fixed percent ownership. Similarly, a trading company you're able to have a fixed percent ownership there. So with this one, we'd look to sell the business from the discretionary trust to one of these options, and then work out how the employee buys in, or whatever it is, where you get a business partner, and then run from there. But this is generally where there's more than one family involved. But it can even look like this where there's, the same family, but you've got your brother or your sister involved in running your business as your business partners, and you want to keep some separation there as well. And that way each of you can have your own trusts or holding companies under this, and so on. Please, any questions, just pop in that chat box. I'll just keep moving through unless there's questions. The next one here is restructuring to allow R&D. So again, we've got the discretionary trading trust as an example. It's not eligible for the R&D tax concessions in its own right. You must have either a trading company or a separate company that you set up in the proposed options here. So the clean, easy option is to have a new company that's your trading entity that's eligible for R&D, or you keep your trading trust and then you set up a company that its purpose is to do R&D, and then the trust engages your R&D company to take that out. So there's two different options there. One's a bit more work than the other in terms of like the moving the trading entity is the one that has a bit more work involved. You're selling an asset over. With the trading trust, keeping that, you're not selling the business. You're just engaging the R&D co. But the effect here is you've got two entities that both of them have ABNs. Both of them will probably have GST registrations. So again, there's a bit more admin overhead. And this is why I say that there's multiple ways that you can do restructures to get a similar outcome, but there might be more pros or cons with certain ways than others, and it's a process of working through that with clients. And even what CGT or stamp duty concessions are available may determine the way that we do the restructure. Alrighty, next one here: restructure to allow family succession. Yeah, again, there's so many ways this could happen. Depends on your existing structure. But the current structure is you've got a trust or a company that the parents control, and they want to pass on the business or the entities onto the next generation. In this instance, especially if the parents are older, you might get some really great outcomes when it comes to capital gains tax concessions. In fact, there's a capital gains tax concession that says if you're over 55 and eligible for the small business CGT concessions, you can disregard. Oh, sorry. The other condition is that you've run and owned the business for 15 years or more, and there's a concession there where you literally ignore the gain. So you can have millions of dollars in a realized business sale and literally pay $0 in tax. But again, you've got to have the right conditions, the right eligibility. And that can be tricky because the broad requirements of the small business CGT concessions is a $2 million turnover in the business, or there's another test that says $6 million net assets. Neither of those are indexed. Like the current $3 million unrealized capital gains tax crap that's going through that Labor's pushing. So the $3 million limit is not indexed, which means that I don't know when these small business CGT concessions came out, but I imagine that $6 million net assets was actually very unlikely to happen, or at least less of a percent then than it is now. Because we do have quite a few clients that are nudging this $6 million net asset. The good thing is that test excludes your superannuation balance. It excludes your family home as well, any private use assets. So you might have a family that's worth, they have an estate and business that's worth $10 million altogether. But if half of that, $5 million is their home and the equity in their house, they might be eligible there. And that's why I say it's super complex when you start getting into complex clients and situations. But the benefits can be insane, where you sell and make you make millions and pay no tax. Beautiful. Alrighty. So what do we do with family succession? Well, we want the next generation to take control. So we want to end up with a trust or a company, whether it's the same entities that ran under the parents' control or it's new entities under the kids' control. We want to end up with the next generation having control of their own entities. And yeah, again, the new structure depends on the outcomes required. We also see it's very common for parents to vendor finance the business purchase for the next generation too. Maybe they take a bit of cash off the table up front, 10, 20, 30%, but they're okay getting paid back over time while the kids step in and run and take risk, and they can get their money over time. Case study number 4. This is a restructure to add a new product or service line or a location. The example I gave was an accounting firm owner wants to purchase and run a mortgage broking business. And to do that, for licensing requirements, simplicity, asset protection, the answer here is to just have separate entities for it. So that would be a product line, but again, we've got we've got a few gyms, especially franchised gyms that we work with, and for different locations they'll have different entities, and often, particularly with franchises, there might be a family that sort of runs and starts all the franchises, but then they want their managers to buy bits of it, so they incentivize the managers to be able to run it. And a popular structure here is a company. Companies are simple, they're well known, and you can sell a percent versus, let's say, a discretionary trust where you can't get that same benefit. So again, getting the structure right when you go into the franchise or set up a location needs to be thought through. Obviously, a unit trust could do the same thing, where you get the benefits of a trust as well. Yeah. The other thing is, where you've got separate business premises, you'll keep different leases in different entities as well. And so if you, again, it's sort of an asset protection one there. Case study number 5, restructure to separate out business assets. Cool. So let's imagine you've got a business that's running in a company, just to keep it simple, but you're starting to buy lots of equipment. Imagine you're a manufacturer in Australia, or you're a company or a business that has develops intellectual property, and what we're looking to do is we're looking to separate out the assets that the business has or uses separate from the trading risk. So because if the trading company blows up or gets sued, we don't want to lose the assets associated with it. And we've got clients with hundreds of thousands of dollars of equipment, that they've got equity in. Essentially, it's worth money. We've got engineering business. We've got manufacturing. I guess it's quite similar there. But we don't want something to blow up in the trading entity and then the creditors come and take the hundreds of thousands of dollars worth of assets. So we've got a separate entity here, and the trading company essentially rents the equipment from the asset co. But you can do that with IP as well. Develop IP in a separate entity and then rent the IP or license the IP to your trading entity. Okay. Cool. Alrighty, Mike. I'll answer that question in the Q&A section as we go through. Um, cool. I think I've talked through this case study. The next one here is restructuring to add in a holding company. So this is relevant where your current structure is a trading company, and over time, we see that clients make profit, they pay tax, and then they've got this thing called retained earnings in the company. So to work out whether you've got retained earnings, you have a look at your balance sheet in your annual financial statements, or if your zero is up to date and it matches what your accountant's doing, you should be able to see your retained earnings in zero. But as your retained earnings builds up in a company, essentially, that's your exposure from an asset protection perspective, from a net balance sheet perspective. But you've also got to consider what your business is worth. So if your balance sheet is worth $1 million through cash or even money you've taken out as loans, they show it as loans on the balance sheet. So if your balance sheet is worth $1 million and the goodwill of your business is also worth $1 million, which may actually not be represented on your balance sheet because often balance sheets are at cost, not at fair value. Where am I going here? You've got a $2 million valued company, and you don't necessarily want to lose the lot if something bad happened. So the motivation here is we want to move. So the goodwill you can't really do too much about in terms of moving it into another non-trading entity, but the retained earnings we can. So what we want to do is push the retained earnings out to a non-trading entity. And in this instance, the suggestion here is to interpose a holding company. And I'll go back a step. So where a company is owned by a trust, it's very common, and it's in fact very common. A lot of structures started like this, and to get money out of the company, we dividend it to the trust, and then the trust can give it to people or entities in the family group who then pay the tax on that. Now, with dividends, there's usually an adjustment for top-up tax depending on who's receiving the dividends through the trust. Now, under this one, even if it ends up in a company or what we call a bucket company, you'll still pay a top-up tax generally of 5%, because your trading entity, a company that trades, has a 25% tax rate generally, and a investment-only co, and there's an exception I'm about to share, but a bucket company where it's sent through a trust, you'll pay tax at 30%. So there's a 5% top-up tax even to get it out in this current structure over to a separate non-trading company, a bucket co. With this structure here, where you put the holding company or the bucket company between the trading co and the trust, why the rules don't match, again, my opinions don't matter. But under this, the holding company inherits the 25% tax rate from the trading company, assuming it meets certain conditions. But if the holding company's only job is to hold trading company shares and receive dividends from that, it's pretty likely it'll get the 25% tax rate. So you're not paying a 5% top-up tax in this structure. And so that means we can move the retained earnings from the trading co to the holding co, not pay a top-up tax because you've already paid 25% in the trading co, and you've shifted that $1 million in my example into a non-trading entity. So again, this is in principle, it's simple, but it's sort of complex to understand the motivations and then even the legislation behind accessing the 25% tax rate in this company, this middle one. It's all quite intense. But we love it because we're not paying, like, and let's use figures. So I mentioned we're looking to move $1 million of retained earnings from trading to some other company. If we don't have this holding co, we'll end up paying 5% top up tax. So we're looking to pay 50 grand in tax just to shift it out and protect it, versus putting it in the holding co and then, whether you loan it back for working capital to the trading company or, we've got clients who invest through their holding companies. So there's all different things you can do there, but at least you're not paying another 50K, to move it out and keep it safe. So again, sort of just recapping some of the things we've spoken about, some of the benefits of restructuring. There could be brand consolidation. I mean, that sounds like it's multiple entities moving into one, which is often the opposite of what we're doing. Streamlining processes, even a clean slate to take the business into the future. Going from discretionary trust to company. Even if you don't have a manager about to buy in, people sometimes just like to have it ready to go in case there is the opportunity. You might want to get clearer on control, especially with family succession. Peace of mind, adding possibilities to your structure. Ability to align the structures to fall under your estate planning wishes. Again, that's another one. If you've got businesses or assets held in companies or trusts, how that passes on to your next generation through estate planning very much matters. And for business owners, when it comes to estate planning, the will, like your will only deals generally with stuff in your own name. So assets in your own name. And if you're a business owner and what we call the risk taker in the relationship, if you've got a spouse, we call one the risk taker, one the asset person. So me, for instance, I've got pretty much nothing in my own name. So the will for me is one of the most useless pieces in my estate planning, because my estate is worth nothing. And so we need to consider, if that's the case for you, how does estate planning interact with your companies and trusts, and where your wealth is stored. Other benefits is, we don't want to pay tax if we don't need to. So how do we look at getting no or low capital gains tax through rollovers and concessions, stamp duty exemptions? In most states, but don't get your hopes up too much in Queensland unless you fall under that particular exemption of discretionary trust to company. And even then, there's rules. You can reset your cost base for your business as well. So we've had instances where clients want to, through a restructure, they reset their cost base. Let's say a trading company purchases off one of their own trusts, and it pays $1 million for it, and they go and sell it 5 years later for $2 million. So they only pay tax down the track on 1 mil, not the full $2 million sale, because they reset the cost base of that business earlier on. Another one is Division 7A management. So we see this one in particular where a company is purchasing the business off a trust, or even the shares off a trust or an individual, because Division 7A occurs. It's sort of a negative thing, where generally the directors or the people who own the business take out more money than they've been taxed on. That's in short how Division 7A occurs. And usually to spend personally, pay off the mortgage, put on the offset account, invest money, whatever it is. And with Division 7A, there's benefits we can get through restructures where a company essentially loans money from a trust or an individual through vendor finance of a purchase, which is the opposite of Division 7A. So it's actually a good thing. So we've seen clients with massive Division 7A problems that are solved through something like a restructure. Again, I don't want to like doom and gloom Division 7A. It needs to be managed. It's not a completely horrible thing, but awareness and being onto it is key there. Another one is working capital management or even protection. In that last case study I gave, I said moving the retained earnings, which could include a lot of cash, to the holding company and then loaning back working capital. Again, it's just an asset protection move there, which covers my next dot point. access to R&D grants and licenses, and debt recycling as well. Um, so again, if a trading company purchases a business from a related entity and it uses debt to fund the purchase, that debt would more than likely be tax deductible, depending on its execution. But yeah, you could even turn non-tax deductible debt into tax deductible within your family group as a result of a restructure. So now we're in the Q&A zone. So for the next few minutes, if you just wanted to pop any questions that you've got in the chat box, and I will run through them. The first one we've got here is from Mike. So he said, something I mentioned earlier, can you share any case studies on restructuring involving vendor financing for a new acquisition transaction using a company? Oh, okay. So I spoke about that a couple of times there, which is basically like, let's say you want to restructure from a discretionary trust to a company. And the company that you set up might have $10 worth of shares, but it can't afford the $2 million purchase for the business it's buying. Often the trust will vendor finance, like provide the finance for the company so the company doesn't have to pay cash because it has none. How does it get it? So the company vendor finances it and pays the loan back over time. And so often in those instances, we'll get a commercial lawyer involved to draft the business sale agreement from the trust selling to the company, along with the vendor finance agreement that carries the terms. We might even look for security too, so that your selling trust is a secured creditor of the new trading entity, and that's even further asset protection for the business itself. But again, in that instance, we've got a $2 million loan payable to a trust. That's a great thing for Division 7A purposes. Yeah, I mean, there's many, many benefits of something like that. Alrighty. Cool. Well, we've got another question. Rajiv, is it the only best way to take out the money for the company entity when you are the sole director of the company? So how to, hmm, I don't quite understand the question, Rajiv, but I'm sort of getting the gist of it in terms of how do you take money out of a company. There's sort of three main ways. The first one is to pay yourself a salary, but you've got to be working in the business. You've got to be working in the company to do that. And you can't just pay, it more so applies to your spouse or other family members. You can't just pay them heaps of money for work they're not actually doing. So you're pretty limited to paying yourself for that one generally. The second way is to take a loan from the company, but that does fall under the Division 7A rules. The benefit of a loan is that you don't get taxed at the time of the loan, but you do fall under these Div 7A rules, which can add up over time. So it needs some sort of management plan or strategy behind it. And then the third way to take money out of a company is to pay dividends to the shareholders, which means that often we want a trust or a holding company to be the shareholder in a company. And we've got to look at the implications to that shareholder of paying the dividend. So to answer your question, the best way very much depends on the client's circumstances, what else is happening in their family group, as to how you actually get the cash out of a profitable company. All righty. Well, I'll keep the chat box open there for a little bit longer. But I guess action points from here. If you're a client, because I can see quite a few clients on the call today, the next step, if you would like to chat to us about, your concerns or motivations for a restructure, then please reach out to the accountant that you work with at Inspire. The team know that the restructuring webinar is happening, so they'll likely expect. They won't be caught off guard in a sense. So that's something you can do to reach out. And then often, especially working through the more complex ones, I'm pretty involved in what are the proposed solutions for it? What are the benefits? That's something that I'm generally quite involved with. If you're not currently a client with us, but you want to talk further about these restructures, the best thing to do is to book a strategy call or initial chat with one of our accounting team. And Tay from our team has just posted the link in the chat box. It's just inspire.accountants/chat. And then you can just have a chat with one of our team about what it looks like to restructure, have a discussion what the motivations are, and then if we feel we can help, we can run through what the next steps might look like on that call. Cool. Mike has asked for the recording. Yes. So generally with our webinars, anyone who registers for the webinar can have access to the recording. So we'll send that out usually the same day. It just depends on how long it takes to upload and generate from Zoom. So yes, there will be a recording for that. But if there's no other questions, it doesn't appear so, then we might wrap up there. But I just want to thank everyone for joining today. I hope you have enjoyed the content and it's helped you. That's my goal for these things. And enjoy the remaining day and a bit of this week. Thank you very much. Thanks, Mike.